Hello students, welcome to Accounting Explained at Accountwise Academy. This is Latha Venkateshwaran. Dear students, today we will learn a very important topic in capital budgeting, the Profitability Index or simply PI. By the end of this video, you will understand what it means, how to calculate it, and how to interpret it to make the right investment decisions. Before we begin, if you have not watched my earlier videos on the time value of money, make sure to check them out. I have shared the links in the description box below. Those videos will help you understand the concept of discounting, which is the base for calculating the profitability index. What is profitability index? Profitability index, also called benefit cost ratio, measures the present value of cash inflows per rupee of investment. In simple terms, PI tells us how much benefit a company earns for every rupee invested. Students, remember the other name for PA is benefit cost ratio. Okay. Second point is it helps in project evaluation and ranking when capital is limited. PA is very useful when companies have limited funds and choose between multiple projects. Here see ranking. So whichever projects has the higher rank or the highest rank, that will be selected. That is rank 1 will be selected. Formula for PA is very easy. Present value of cash inflows divided by initial investment. Cash inflows in initial investment and discount rate will be given in the exam. You have to just find out the present value of cash inflows. That's why I told you that you have to be thorough with the time value of money. Okay, discount rate, discount factor or cost of capital all are same. If they use any of these in the any one of these in the exam, don't get confused. All are same. Okay. Let us learn the acceptance rule for profitability index. If PA is greater than 1, straight away accept the project. If it is lesser than 1, without second thought, reject the project. Now that we know the concept, let's move on to an exam question to see how it works in practice. A company is considering two investment projects, expanding its existing factory and setting up a new factory. It wants to see which one is profitable, whether expanding its existing factory or to set up a new factory. The cost of capital or the discount rate is 10% for both the scenarios. Okay. So the information given in the question are as follows. The columns are particulars, factory expansion, new factory. And the initial investment for the factory expansion is rupees 10 lakhs. For the new factory, it is rupees 12 lakhs. Annual cash flows for 5 years. For factory expansion, it is rupees 2 lakhs. And for new factory, it is 3 lakh 50,000. This is the question which we are going to solve now, and we are going to take the first scenario of factory expansion. PI formula is present value of cash inflows divided by initial investment. So first we have to find out the present value of cash inflows. For that we need the discount rate or discount factor, cost of capital all are same, which is 10% for both the scenarios. So let's take the scenario 1 and find out the present value of cash inflows. For that I have opened a table which has the following columns. First column is here, second column is cash inflows, third column is discount factor. Formula is 1 divided by 1 plus R the whole power n. R is the discount rate which is 10%. Okay. And present value formula is cash inflow into discount factor. That is column 2 into column 3. For year 1, cash inflow is 2 lakhs and discount factor is 1 divided by 1 plus R. So 1 divided by 1.1. 1 plus R is 1 plus 0.1 is 1.1. Okay, since it is year 1, we are taking 1.1 directly. 1 divided by 1.1 is 0.909. Column 2 into column 3, that is 2 lakhs into 0.909 is 1 lakh 81,800. Second year, cash inflow is the same 2 lakhs and discount factor will become 1 divided by 1.1 to the power of 2. Whole power n, no, now n becomes 2. On calculating, it comes to 0.826. Column 2 into column 3 is 1 lakh 65,200. Here 3, 2 lakhs. 1 divided by 1.1 to the whole power 3 comes to 0.751. Column 2 into column 3 is 1 lakh 50,200. Here 4, 2 lakhs. Now discount factor becomes 1 divided by 1.1 to the power of 4. Correct. So it comes to 0.683. Column 2 into column 3 is 1,36,600. Again, year 5, cash inflow is same 2 lakhs. Now discount factor can becomes, now by this time, 1 by 1.1 to the power of 5, which comes to 0.621. And present value is 1,24,200. Total present value of cash inflows is, you have to total all these things, which comes to rupees 7,58,000. This is for the project expansion. PI formula is present value of cash inflows divided by initial investment. Present value of cash inflows is 7,58,000. Now we have to incorporate this in the formula. So 7,58,000 divided by, for factory expansion project, initial investment is 10 lakhs. Okay, divided by 10 lakhs, which comes to 0.76. 0.76 is lesser than 1. So we have to reject the project of factory expansion. We are going to do the second scenario, setting up of new factory. As we did for factory expansion, we are going to do in the same way for new factory also. That is, we are going to find out the present value. Here, the cash inflow for setting up of new factory is 3,50,000. So, for year 1, 2, 3, 4, 5, your cash inflows will be 3,50,000. And discount factor, as we found for factory expansion, like 1 divided by 1.1, 1 divided by 1.1 to the power of 2, like that we have to find out. And same discount factor will be used because discount rate is same for both the projects. So which comes to 0.909, 0.826, 0.751, 0.683, 0.621. When you multiply column 2 with column 3, you get for first year 3,18,150, second year 2,89,100, third year 2,62,850, fourth year 2,39,050, and fifth year it is 2,17,350. So total PV of inflows for the new factory project is 13,26,500. PI formula is present value of cash inflows divided by initial investment. So total present value of cash inflows, we found it as 13,26,500. 13,26,500, and the initial investment for the new factory project is 12 lakhs. Divided by 12 lakhs comes to 1.11. This is greater than 1. We can accept the project. I want you to do a comparison table like this, which has the following columns of project, PV of cash inflows, investment, profitability index decision, and rows of factory expansion, new factory. You can fill up this column with the solution which we just did. Okay, when comparing both the projects, the new factory has higher profitability index. So the company should choose the new factory project since it generates more value per rupee invested. My dear students, here is an important exam tip. In your exam, I want you to present your answer in a similar comparison table. When you show the calculations clearly like this, it becomes very easy for the examiner to evaluate your answer. And trust me, you will score full marks for neat and structured presentation. Let's have a quick recap of what we have learned so far. PI is equal to present value of cash inflows divided by initial investment. In your exam, cash inflows, initial investment, and discount rate will be given. Just you have to find out the present value of cash inflows with the help of the discount rate given and then divide it by initial investment. Now, if PI is greater than 1, accept the project. PI is lesser than 1, reject the project. Higher PI means a more profitable project, and PI helps rank projects when capital is limited. My dear students, if you found this video helpful, don't forget to like, share, and subscribe to my channel, Account-Wise Academy, so that it will encourage me to make more videos like this. If you would like to inquire about the online classes which I take, or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.